In today's video, you will learn what a health savings account is and why it's the most tax-advantaged account. I'm Thomas Cook, a certified financial planner, an enrolled agent for the IRS, and the founder of a wealth management firm that specializes in helping individuals maximize their life and minimize taxes in retirement. So with that, let's dive in. A health savings account is the most tax-advantaged investment account available, and many know it as the triple tax-advantaged account because the tax-deductible contributions, the tax-deferred growth, and the tax-free distributions for qualified medical expenses. Still, it has a fourth tax advantage that is not discussed enough. So suppose you fund your health savings account, commonly referred to as an HSA, through your employer plan, specifically a Section 125 or cafeteria plan. In that case, you don't have to pay the 7.65% payroll tax on your contribution amount, right? And that's 6.2% Social Security, 1.45% Medicare. So in the world of investing, there is no other account like this. The strategy to maximize the tax benefit is to fund your health savings account, invest it for long-term growth, and then use cash outside of your HSA to cover any medical expenses. So that way you're not interrupting the long-term compounding. It's because time is the key ingredient for compound growth. So keep a record of your medical expenses and receipts as you can reimburse yourself tax-free from your health savings account at any point. Because the tax benefits are so great, there are specific requirements and restrictions to contribute to a health savings account, right? So for example, you must be covered by a high deductible health plan above the minimum deductible amount. And in 2024, it's $1,600 single or $3,200 family. And it also must have a maximum out of pocket below $8,050 single and $16,100 family in 2024. You're also capped on how much you can contribute to this account. So again, for 2024, you can only put in $4,150 for self-coverage and $8,300 for family coverage. If you are 55 or older, you can make an additional $1,000 catch-up contribution, and the same goes for your spouse. If they are 55 or older, they too can put in an additional $1,000 catch-up contribution. Now, here's the catch though. They have to do that in their own health savings account. So if you have a family plan through your employer, you can do the $8,300 in your HSA. You can do the $1,000 catch-up in your HSA, but to get your spouse's $1,000 catch-up, they would have to open up their own HSA. And Fidelity is a great resource where you can open up a health savings account in the name of your spouse and make their annual catch-up contribution and still invest it for long-term growth. If you follow this strategy at an early age, chances are you will accumulate a lot of money in your health savings account. So what happens to this money once you're age 65? Or maybe what happens once you get older and you have more money in this account than you have qualified medical expenses? Well, good news, at age 65, you can distribute money from your HSA as if it were an IRA, right? So you will still be taxed on the distribution, but you are no longer penalized for using it on non-medical expenses, okay? There is an important difference to know for when it comes to estate planning, okay? Your spouse can inherit your health savings account and continue the tax benefits of an HSA, but a non-spouse beneficiary has to withdraw all the money and pay income tax on the account's fair market value the year that it's inherited, right? So this is much less favorable than an IRA, as an IRA non-spouse beneficiary has 10 years to distribute that account tax efficiently. Again, my name is Thomas Cook, certified financial planner and enrolled agent for the IRS. Thank you for making it to the end of the video. I hope that you found this helpful.